You make your case for 4 this year and 3 next year.
Well, I think the economy is showing signs of overheating. Obviously, you've got an unemployment rate below 4%. Growth is going to be very strong in the second quarter. And the Fed needs to get to neutral pretty quickly. They've been very easy for a very long time, and I think it's time to, get back to neutral. I don't think that they would accelerate beyond what they've called gradual. So I think 4 is kind of the cap for this year and next, but I think it's going to be pretty close to that cap.
Bob, make your case.
Well, we think the economic growth that we're seeing this year is as strong as it gets over the 5 years when we look forward. And so without doubt, we acknowledge there's strength in the data today, but we look at where we think the environment's going to be a year from now. And when we look out 1 year, and we encourage the Fed to look out a year, and I'm sure they do, we think inflation will be moderating, growth will be lower, the fiscal stimulus impact will be wearing off, and then the rest of the world will also be in what we would call a lower growth channel. So if you look out over a year, it's hard pressed for us to see the Fed being very aggressive beyond what we expect them to be doing.
So, Bob, that's a year from now. What about today? We have CPI numbers out in just a little under an hour from right now. If those come in fairly robustly, aren't they going to be well above their 2% target? Aren't they really running it pretty hot?
Well, we went for years with the inflation numbers below the 2% target. And people like Charlie Evans and others from the Fed have rightly pointed out that seeing numbers slightly above 2% for a few quarters should not be viewed as a threat to one of the Fed's mandates of stable prices. It should not be seen as a ceiling, but basically a target. So if we get a couple of prints of 2.25, 2.5, this year, that should not be an issue. It certainly is not an issue for the bond market when you look at how flat it is and where the 10-year is trading 1 year from now. The 10-year is trading at 3.06 1 year from now in June, and so clearly the bond market is not worried about long-term inflation.
So what about it, Stephen?
Well, I think Bob's right that if inflation moves above 2%, the Fed's not going to pull the fire alarm right away. But I think there's a key distinction there. If the inflation numbers say 2.2 and they expect it to stay at 2.2, that's not a problem. If it's 2.2, 2.3, 2.4, continuing to accelerate, then I think it does become a problem. I would also say, to Bob's point about the market, I mean, 3% 10-year in a year, and he's talking about 2.5% inflation. That's a very low real interest rate. And I think that's kind of part of the problem here is that the monetary policy environment remains very stimulative.
So Bob, is all the tax cut baked in already? Because shouldn't the Fed be concerned that they haven't seen all that yet? There might be further inflation right there.
Well, that's admittedly one of the big issues that needs to be resolved by the economy and economic decision makers every day is whether or not the stimulus is going to create this virtuous, sustained cycle beyond 2018. And we think it's premature to be that optimistic. And so we think the stimulus impact will be most felt this year. And what it's really doing is extending the life of the cycle as opposed to really adding to the magnitude of it. So we think that over the next 5 years, economic growth is going to be in the low 2s. And that's so, once again, just to reiterate, the best growth is going to be this year. It's not going to be there's not going to be a lot of momentum going into 2019.